can hear me. And thanks, Ushi, for organizing this event. It's really a great turnout. We've not seen that many people come to, WSB event, so very welcome. As Ushi's mentioned, I'm joined here today by Freddie, who's going to be running the session with me, but later on in the slides. So in today's session, we've attached 2 documents, and hopefully you've had a look at those documents, which contains the discussion paper, which is the very long document, which contains the detailed proposals of the WSB, and also the snapshot document, which is the 12-page document, which gives, I guess, an overview, high-level overview of the proposals, if anyone's not going to be able to have the time to read the long, very long document. So what we're hoping for in today's session is actually to get your views on some of the key proposals that the WSB's come up with, and especially where you disagree with any of the proposals. We really love to hear feedback from you so that we can provide the board with the reasons why you disagree with the proposals. And hopefully we'll bring the slides up. About great technology skills at the WSB.
Yes, it's what we do.
Hopefully you can see that. No? Here comes the IT guru. All right. Whoops. Admit all. There we go. I knew there was a button somewhere. Admit all. Okay, here we go. So as I was saying, so we would love to hear feedback from you on when you disagree with the proposal so that we can hear the reasons why, and so that we can feed it back to the board when they decide on the next steps. Now, there are a number of ways that you can provide feedback, not only just at this session, but we have developed an online survey, which we really encourage everyone to complete after this session. And also, obviously, we would love to get any written responses if you are very keen to give us written responses. But Freddie's going to take you through other ways of how you can provide feedback to us. So here's today's agenda. So we're going to cover on why the WSB is consulting on the discussion paper, the entities that may be affected by the proposals, and we are also going to be obviously covering some key proposals. We're not going to be able to discuss all the proposals, but some of the key ones where we've heard feedback mainly on the application issue, like especially for smaller entities, application issues and difficulties applying those standards. So, and obviously the how you can provide further feedback to us and where to go for more information. All right, thank you. So the board's been working on this project for some time with the view to develop a further reporting tier, being Tier 3 general purpose financial statements. And the primary objective is to develop simplified financial reporting requirements that meet the needs of financial statement users of smaller entities. Now, at the same time, the board's also going to be proposing to remove the ability for preparers to not-for-profit entities to prepare special purpose financial statements if they were required to prepare financial statements in accordance with Australian accounting standards. One of the main reasons why the board's proposing its proposals is because we've heard feedback from stakeholders that the current accounting requirements are quite challenging, especially to be applied by smaller entities. And so what the board's hoping is with its proposals, it will be able to provide simplified accounting requirements for smaller not-for-profit entities, and therefore reducing the cost of preparation and also improving comparability and quality of this financial reporting. Now, the entities that may be affected if the proposals were to come into effect are not-for-profit entities that are required to prepare financial statements or financial information in accordance with a direction. So that could be in accordance with a trust deed or in accordance with a constitution, or if they were to comply with a regulatory requirement. So that could be, say, submitting financial statements to the ACNC, ASIC, or ORIC, for example. So if they were to require to prepare financial statements or financial information based on those two requirements, then they may be caught under these proposals. So that means entities that are currently preparing either general purpose financial statements or special purpose financial statements may be affected by these proposals. Now, the proposals for T3 accounting requirements were developed based on transactions of not-for-profit entities with revenue between 500,000 to 3 million. However, the AASB is not intending to develop any reporting thresholds within the Australian accounting standards, because the board's of the view that requiring or determining who should required to prepare financial statements is within the remit of the legislation or regulatory authority. So as part of this project, we've updated Research Report 10, which provides information on the types of entities that may be affected by the proposals by identifying entities with financial reporting obligations under the state of Commonwealth, state or territory legislation. So we really encourage stakeholders who are interested to see which entities are going to be impacted and the financial reporting legislation that sits behind those requirements to have a look at the Research Report 10, to have a look at the entities that may be affected. So now this comes to the very main reasons why we're talking to you guys today, is we're going to take you through some of the key proposals, as I said, and how we are wanting to capture the feedback is we're going to run a series of polling questions. For those that are online, you will see the polling questions, and obviously there are audiences in the room today. So I think what we will try to do is capture your responses of the audiences that's physically in the room by raising your hands when we ask the questions. If you agree, thank you. If you don't agree, again, we'd love to hear why you disagree and the reason so that we can report it back to the board. So we will start off with consolidation of subsidiaries. So this is one of the accounting standards that we've heard from many stakeholders that it's quite challenging for not-for-profit entities to apply the AASB 10 requirements. So what the board's proposing is to allow a parent entity the choice to present either a consolidated set of financial statements or separate financial statements with disclosures of information about the parent entity's significant relationships. Now, the information of what will be required and what is meant by significant relationship is not yet decided, because at this stage, the board's interested to hear feedback first, whether or not stakeholders actually support having that accounting policy choice before deciding what the requirements are for separate financial statements. Hopefully, we can launch this. Thank you. I think, yes, so we have the first polling question of the day. So do you agree with the proposal to provide entities with a choice regarding consolidation? So we'll give everyone online a couple of seconds to complete. And again, if we can have for the room to raise your hands if you agree for allowing that accounting policy choice. So I think if we can put your hand up really high up so we can do the count.
3, 4, 5, 6, 7, 8, 9,
10.
Yeah.
I think 10. And then if you disagree, if you're brave enough to raise your hands, anyone disagree? Please let us know.
I think you can make a poll.
Or end the poll and share the results. So we do have majority agreeing with the proposal, but we do have one person that disagrees. And I think this comes from the online participant. So we would love to hear back from the online participant why they disagree, the reasons why, so that we can understand how we can improve on the proposals. And I think because it's a Zoom, you can just unmute yourself to provide that feedback.
Craig Fano here. I didn't disagree. I actually didn't vote. But I have a question about the threshold. And sorry if I missed. I heard somebody come in just before. Is the threshold for all the parent entity and the sub entity, or is it separate entities? So would the threshold apply if they were each treated separately, or is it just the overall amount of income across all entities?
So yes, thank you. So I guess the question is, it will really depend on the regulatory requirements or the legislator, how they're going to impose or consume the proposals. So we are not going to specify any reporting thresholds. So it depends on if, say, for example, ACNC may accept the proposals and only allow single entities with revenue between 500,000 to 3 million to apply these T3 proposals, then it will be based on the parent entity. Let's say, and then, for example, ORIC might have a different view where at the moment they determine reporting requirements based on consolidated revenue. So it really depends on what the regulatory requirements are for that regulator. And did you want to, I hope that answers your question, Craig.
So how much choice then really is with the entities and how much is actually just driven by regulators, I guess is my response.
Freddie?
Yeah, no, it's a good point, Craig. And obviously the interplay between future accounting requirements and the legislation or regulation requirements is an important one. And I think that's where we just need to really wait and see. We can only get that far. I think that interaction is already there because those that are preparing special purpose financial statements may decide not to consolidate for whatever reason, and also the regulators may have differing thresholds whether they are looking at revenue of consolidated group or individual entities. It's not dissimilar to when we are talking about the application of these future tier 3 requirements. If the board decides to progress, is that some regulators may actually not necessarily entertain tier 3 and they will require all the entities to prepare tier 1 and tier 2 for whatever reason. At the same time, other regulators or other pieces of legislation may allow a different set of entities to prepare either tier 1, tier 2, or tier 3, depending what they will, what they wish. So I think that's where, and this is the start of the public consultation process. It's a discussion paper. So if the board decides to progress, we'll progress to something that would call exposed draft. So it's not the end of the story, quite on contrary. And we do actually have a specific discussions with all regulators that we were able to identify to ensure that they are aware of the project. They are thinking about when they are going next time to change their legislation or regulation to take these preliminary views at least or project into the account. But obviously there is no standards to adopt as yet. So it's something that we definitely consider. Similarly, when we get to the revenue discussion, I think very shortly, there will be the same or similar question that different revenue requirements between tier 2 and tier 3 may create a question, well, what does entity do when they are close to the threshold between a smaller and or medium and large charity? And that's again something that we need to discuss with the regulators and see whether they are comfortable with the difference. But again, not different to now, where an entity preparing special purpose financial statements may have just different revenue recognition criteria for similar entity that prepares general purpose and applying AASB 15 and 1058.
Thank you. And I think the main message is that we're not doing this project in isolation. We are definitely actively consulting with the regulators as we speak, and obviously trying to get them on board in terms of how the future T3 interacts with the legislation. So we're moving on to the next topic, which is income, and obviously is one of the more complex accounting requirements to apply for not-for-profit entities, being there's two AASB 15 and AASB 1058 at the moment. So what the board's proposing is to propose a new income recognition model, which requires an entity to assess whether there is a common understanding between the funder and themselves on how they are expected to use the resources, inflows of resource in a particular way that results in outflows of resources. Now, the common understanding would need to be evidenced by the funder either in writing, so that could be in an email or contract, or in some other form, so for example, in a recording. Now, to manage resources in a particular way that results in outflows of resources will include transferring of goods or services, performing a specified activity, incurring eligible expenditure for a specified purpose, and using the inflows of resources in respect of a specified period. Where there is a common understanding, then that's evidence. Income is deferred and recognized in a manner that most faithfully represents the amount and pattern of consumption of those resources. So for example, for goods and services, that's when services are delivered or when the activities are performed. Or there could be situations where the not-for-profit entity may get donations from a funder that specifies that they must spend the funds within the next 2 years. Then income can be deferred and recognized equally in the following 2 years. And for all other income transactions where there is no documented common understanding, then income is recognized immediately. So we will launch the second polling question, which is whether you agree that income is deferred when there is a common understanding between the funder and the recipient of how the funds will be spent.
So also in the room, if
Yeah.
you agree with the preliminary review, just put up a hand. 1, 2, 3, 4, 5, 6, 7, 8. Any that would disagree with the proposal or preliminary review in the room? No disagreement, so there will be few people who need to think more about the topic.
Definitely. And as we said before, there are many ways how you can provide feedback as you consume all this information. So I think we can end the poll and share the results. So on the online participants, everyone's agreeing. I do see a hand up from Motto E7. If you can unmute yourself, happy to, if you have any questions, please feel free to ask them. I think they can just unmute themselves. Yeah. Yes. Craig, to answer your questions, this will apply for both philanthropic donations as well as contracts. So it's everything that's an income transaction.
Okay, if there are any
If there's no questions either online or in the room, we might move on. So yeah, we stretch on time. So the next topic is on leases. So again, one of the more complex accounting requirements under AASB 16. So what the board's proposing is to require Tier 3 entities to recognise lease payments as an expense on a straight line basis over the lease term. And a corresponding requirement would apply to lessors as well. So they'll record lease receipts as income on a straight line basis over the term of the agreement. So what that means is that an entity would not need to recognize a right of use asset. I see smiles in the room, so that's good. And all leases will remain off the balance sheet. Now, disclosures about the entity's outstanding lease commitments would need to supplement the proposed lease accounting requirements. And for concessionary lease arrangements, accounting would be treated as the same as the proposed lease accounting requirements. So we will launch the third polling question now. Is whether or not you agree with the proposal for entities to recognize lease payments on a straight line basis over the term of the agreement rather than on the balance sheet. So in the room, raise your hands if you agree.
1, 2, 3, 4, 5, 6, 7, 8, 9. Thank you.
Thank you.
Any disagreements or different views in the room? No. I would just probably remind that obviously this is for tier or future tier 3. So because obviously the decision making is different for those compared to the larger not-for-profits that would apply tier 1, tier 2, and then obviously would continue with the AASB 16.
So we'll end the poll and share the results. So we do have one disagreement. So again, we'll love to hear feedback from the participant on why you disagree, to let us know so that we can provide that to the board as we consolidate all the feedback back to them. Or alternatively, please enter anything you want in the Q&A and we can capture that as well. No. All right, I think in the interest of time, we might move on. So next topic is non-financial assets acquired at significantly less than fair value. So that's a mouthful. I know we understand that, but what we meant by non-financial assets are things like property, plant and equipment. And when we refer to assets acquired at significantly less than fair value is because sometimes not-for-profit entities may be donated an asset, so that's for free, or sometimes they might get a significant discount to purchase an asset, for example. So that's to cover all those scenarios. Now, for the Tier 3 proposed accounting requirements, the board decided to allow an entity the choice to initially measure the non-financial assets at cost or at fair value, and for inventory at cost or its current replacement costs. However, one of the conditions for an entity that chooses to initially measure those assets at cost is that they will not be permitted to elect to revalue those assets subsequently. So what that means is any assets that will always be carried at cost, and we understand that sometimes for those donated assets, the cost will be zero. So appropriate disclosures would need to accompany that choice, the initial measurement choice. So we'll launch the fourth polling question, is whether or not you agree with the proposal to provide entities the choice to initially measure non-financial assets acquired at significantly less than fair value, either at cost or at fair value.
So what about in the room? Do we agree with the option to recognize at costs? See 2 out of 13 people, 4, 5. Okay. Anyone who
disagrees?
Do you mind to expand?
I think there is a significant deviation from not being recognized at a fair value. That's the main reason why would I say. When I look at the balance sheet, I don't really think it does make a sense. Looking at the numbers which are less than a fair value.
Okay.
And probably it could even impact maybe the way the business is on the funding and down the line. Significant other areas like performance analysis and stuff.
No, thank you. And obviously that's always a balancing act between
simplification
and the value to the users and management committees, etc. What are the common types of those non-financial assets you do see that are recognized currently at fair value that would be then potentially recognized at cost? Are there any common examples? Is it, I don't know, donated vehicles, buildings? Are there any particular types that come to your mind that would be then particularly problematic if they would be recognized potentially at cost?
Not that I can think of. This is my first column.
Yeah. Okay. Okay. Thank you.
So we just share the online results. Let me just. So we do have 2 online that disagree. So again, we'll love to hear feedback from the online participants why you disagree. Again, alternatively, there's other ways that you can provide feedback. Again, as we stress, there's an online survey that we would love for everyone to complete at the end of this session, where it does contain comment boxes where they can put in the reasons why they agree or disagree with the proposals. So we'll move on now to impairment of non-financial assets, because we've just talked about non-financial assets, right? So one of the reasons why the board's decided to simplify the requirements is because we've heard feedback the current impairment model is quite challenging to apply for smaller not-for-profit entities. So what the proposed accounting for impairment is to simplify the existing model and only require non-financial assets that are subsequently measured at cost or deemed costs would be subject to impairment testing. And an entity will only need to consider impairments when the asset has been physically damaged. So that could be in the event of a fire or flooding, or if its service potential is adversely affected by a change in the entity's strategy or changes in the external demands. So let's say, for example, an entity has a 5-year contract to deliver services, but that got cut short to 2 years. So that would be an example of when they need to consider impairments. And a non-financial asset is impaired if its carrying amount exceeds its recoverable amount. Now, recoverable amount is the higher of its fair value, less cost of disposal and its value in use. But to help smaller entities to determine its recoverable amount, the Tier 3 requirements will include a rebuttable presumption that fair value less cost of disposal is expected to be the most appropriate measure of recoverable amount. Now for inventory, the current impairment requirements would continue. So an entity is required to ensure that items of inventory are measured at the lower of cost and net realizable value, and items of inventory held for distribution are measured at cost adjusted for loss of service potential. So we will launch the 5th polling question. Ooh, not the next slide. Is whether or not you agree with the proposal to only impair non-financial assets subsequently measured at cost and only when they are physically damaged or when their service potential is adversely affected. So if I can have people in the room to raise your hands if they agree. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. Anyone that disagrees, if you can raise your hands or let us know. And I think we can close the poll and share the results. So we do have everyone agreeing on this one. So great results for us. So what I'll do now is I'll pass it on to Freddie, who will take you through the remainder of the presentation. Thanks.
Thanks, Maggie. And before I forget, if you have any further thoughts, and we'll talk about it later, you will have our contact details. Please do get in touch and we can have a separate offline discussion on any of those aspects of those proposals. As Maggie already mentioned, it is important. Board is absolutely keen to get the balanced views. And personally, I'm always interested in that 1% of people who may not necessarily agree, because there might be some important points, and we would rather hear those dissenting opinions now at the discussion paper stage, as opposed to in, I don't know, a year time when we'll be discussing or closing on exposure draft. Anyway, moving on to the financial instruments, which I know is the topic that excites everyone, including myself. So the financial instruments accounting standards are always one of those more complicated ones, and that's why it was probably no-brainer for the board to decide that there is probably some simplification needed. Now, as Maggie mentioned, this Tier 3 proposal is around smaller not-for-profit entities, including charities but not limited, but also about common transactions for those smaller not-for-profit entities. So the board, before we actually went down and discussed what would be the financial instruments accounting requirements, we first thought, okay, what might be the common transactions or financial instruments transactions for those not-for-profit entities? And that's why we came up with board came up with 2 lists. On one left-hand side, it's a list of the basic financial instruments, what we think are the simpler ones and probably the most common for those smaller not-for-profits. And then on the right-hand side, you see the more complex ones. The Tier 3 would have a specific requirements, and we'll get to them shortly for those basic ones. For the smaller, for the complex ones, where you can see, for example, derivatives, it would be the entities would be still required to apply AASB 9, for example, requirements in terms of the recognition and measurement. You can see some of the basic ones is cash, term deposits, but also ordinary shares or management investment schemes units. So with that, we would like to see your opinion on whether we got that list right or both of them. And obviously we are keen to hear, is anything missing on those simpler ones or basic ones, or is there something that we thought that it was complex and it should be basic, or vice versa? So keen to hear, or have we missed a financial instrument that is quite common for those smaller, not for profits entities? So yeah.
It's a bit hard for people in the room also.
Yeah, okay. So also people in the room, when you're looking at that list, is it about right, or do you think we need to add something on the list of those basic ones, or something on more complex ones? And again,
all of the other questions. My question is, theoretically, when the threshold you exceed the threshold, now that we are doing a simplified financial statements, how we're going to transition from the simple to the new one that's not in the T3?
Yeah, no, good question. Thank you. So because this is a discussion paper stage, we didn't get to the transition rules as yet, but obviously there will have to be some, because entities will cross the thresholds. Now, again, in conjunction with regulators, I think the aim would be to ensure that entities, just because of the blip in their revenue for 1 year, they don't necessarily have to go up 1 year and then go down next year. And I think that's already, I think in ACNC rules, it's probably they are looking at 2 or 3 years period. They are not looking at every year and waiting for entities to come across. So that would be probably built in. Again, we would be looking at the regulators and legislation from their side. On our side, there would be some transition rules, how to move, well, first on initial adoption, because entities will be at the moment preparing either special purpose financial statements that still exists for not-for-profits, or tier 2, some tier 1. And there will be entities from all these groups that will probably move into tier 3. And at some point, as entities, charity or not-for-profit is growing, they may move from tier 2 to tier 3 to tier 2. There will be transition rules, but they will be not necessarily set for entities moving up and down. That should not really happen, because then it's either regulatory thresholds, we need to do something about them, well, not necessarily us, or we will have to capture something in the standard. Yeah.
So if I can get people in the room just to raise their hands if they agree to this list that we've come up with, so I can do a count. Also, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11.
Thank you. I was about to say I can multitask. I will end the poll and publish the results so people online can see as well. So we can see the majority agreeing. I see 1 no, and we had a couple of hands up, but I guess the other 1 hand was to ensure that we publish the results of the poll. So hopefully that's done. But yeah, if you have any further questions or comments, do let us know. Put your hand up or put something in the chat, and if I can multitask, we'll capture that. In absence of any further comments or questions, we'll move on in terms of what would be then the financial instruments accounting requirements for those basic ones. So in terms of stepping down through this very simple slide from top to bottom, the initial measurement would be similar to the one in AASB 9, which is the Australian accounting standard dealing with financial measurement predominantly. And those financial instruments, including basic ones, would be recognized at fair value. But then the simplification would be that the borrowing cost would not be capitalized, or transaction costs would be not capitalized, but would be expense straight into P&L. So that's a simplification compared to the tier 1 or tier 2. In terms of the subsequent measurement, those financial assets that would be held for both income and capital return. So it's similar to business and cash flow model tests in AASB 9, but much simpler, would be required to be recognized at fair value through other comprehensive income, and we'll get there very shortly. Then other financial assets, those not held for income or capital return or financial liabilities, would be recognized simply at cost. Now let's pause at fair value through other comprehensive income, because obviously alternative is to possibly recognize those fair value changes through P&L, and there are two sides of the discussion argument. So we will we just launched a poll whether the attendees today's session agree that those fair value should go through other comprehensive income or no, and therefore, well, one of the natural alternatives is to recognize the fair value through P&L. And there are two schools of thoughts. One is that some entities and some commentators don't want to combine financial instruments outcomes with the operational results. So they like to keep separate operational results in statement of profit and loss or whatever name we would use, and to keep the financial instruments or changing fair values in OCI. Other school of thought that they would like to have all of that in one place, and OCI, other comprehensive income, is something that these smaller entities may not fully understand or their stakeholders, and therefore they would like to combine it in the P&L and maybe just use some clear labels to distinguish. So that's the background for this decision. Board decided as a preliminary review to go ahead with other comprehensive income, because we are using it for other categories, like for example, evaluation of PP&E, and it makes sense to segregate those two financial instruments from the operational results. But again, there's a few arguments that can go the other way. So in the room,
yes.
where would do you agree with fair value for those financial assets held for income and capital to go through OCI, as is the preliminary view? So who agrees with that? Please put a hand up. 1, 2, 3, 4, 5, 6. Yeah.
I think I agree.
Mhm.
It's just that it would be, it depends on the reader of the financials. I
Mhm.
think.
Yeah, thank you. Is there someone who would strongly prefer profit and loss geography and would therefore answer no to this question? Okay. I will end the poll and publish the results for our virtual attendees as well, to see how they voted. So we can see that majority is in favor for OCI. But again, if you have any further thoughts, anyone online or in the room, please, after this session, please do let us know and we can chat. Moving on, and conscious of the time, in terms of interest, income, and expense, the simplification would be that instead of using effective interest rate, the interest would be recognized using contractual rate, and any premium discount would be just amortized over the life of the instrument. Impairment, instead of the expected credit loss model that is in AASB 9, we would go back to something that we had under IAS 39, and similarly to the impairment of non-financial assets, the impairment would be recognized using incurred cost model. So the loss would be recognized when it's probable that carrying amount will be not recovered, and the shortfall would be the measure, or expected shortfall would be measure of the impairment loss. So again, entities don't have to look through their transition matrices, etc., but can go back to IAS 39 almost model in simplified way. In terms of the derecognition, the financial assets will be derecognized when their rights to cash flow expire or they lose control of the assets. So again, any considerations of continued involvement or pass-through arrangements that are again present in AASB 9 would be not present in Tier 3. And in terms of financial liabilities, when the obligation is discharged and the financial liability is derecognized, and any modifications of the financial liabilities would result in derecognition, as opposed to AASB 9, where some modification can actually may not result in derecognition. Hedge accounting, not permitted, because again, even if they are not small or not for profit, has a derivative, which is not necessarily which is not necessarily uncommon, then hedge accounting should not necessarily help them in any case, and embedded derivatives, those that are presently identified, would not be separately recognized. So for all other those more complex instruments, which we have seen on the right hand side of those of the previous slide, then AASB 9 would apply, and board didn't make their mind yet how to operationalize that, whether we would put a reference to AASB 9 in a tier 3, or whether we try to reproduce AASB 9 in somewhat simpler language in tier 3, but I would still make for a very long tier 3. So that's something that we have to consider. Anyway, there is a poll whether you agree with the proposals that are really summarized on this slide, and I appreciate that it's a busy slide. So happy to take any comments or questions and your views. Please. You agree? Well done. Yep. Well, let's move to the voting. Yes. So who agree? Who in the room agrees with the proposals? But I got it about right. Excellent. Thank you. And I see that we have majority of virtual participants leaning the same way. I will end the poll and share the results, so everyone can see. So we don't have any disagreements. But again, yeah, if there is anything after, do let us know. Stop sharing. Thanks, Maggie. I love this multitasking. Yeah. Yes, please. Absolutely.
Fancy about investing in Bitcoin, where would that fall into the scheme of things?
That's a very good question. We'll get to the intangible assets, because obviously we are at the moment following what AASB said in their agenda decision, and I'm not going into detail, but Bitcoin, or that question that was asked, it's actually not a financial instrument. It was either intangible or inventory, and at the standard settle level, there is ongoing discussion what to do with the cryptocurrencies. And because there is so many actually types of the cryptocurrencies, it's actually not an easy question. So we have a research project on our work program to see how to deal with that. Same as the International Accounting Standards Board. But there is an agenda decision, but it's a particular type of cryptocurrency. And it was decided it's either intangible or inventory. We haven't dealt with crypto in tier 3 as yet, but again, we'll get to that question very shortly so we can have the discussion. And I suspect I have seen not-for-profits, for example, receiving donations in crypto. So it's on our radar. Before we'll get to that exciting topic of intangibles, in terms of the primary financial statements, cutting story short, the board in the preliminary reviews decided that some kind of statement of balance sheet or statement of financial position, P&L, other comprehensive income, and statement of cash flows and the notes should be part of the tier 3 financial statements. There was from the stakeholders' perspective, there was less of consensus whether we need statement of changes of equity. Because again, one side of the argument is that it's very useful statement. For example, check the integrity of the financial statements, and those that are bookkeepers or accountants in the room like me, you remember how you are chasing the $1 or $1,000 and rounding, and there's a few things that can transpire through statement of changes in equity. On the other hand, these smaller not-for-profits may not have anything else in that statement of changes in equity in terms of the changes, maybe just the result for the period. So the question is, do we need to have a separate page in the financial statements for that, if that information can be presented in the notes, for example? So the question then is, in our poll, so board hasn't made a decision on that one yet, and that's why we have a question to you, whether you think that statement of changes in equity should form part of those tier 3 general purpose financial statements. So we'll let our virtual attendees to do their voting, and to you in the room, do you think we should have statement of changes in equity? Is it useful in tier 3? 1, 2, 3, 4, 5, 6, 7. Cool. So I see majority.
We want to hear why.
Yeah, I see the majority agrees. Why is it useful? Thanks, Maggie, for your reminder. Why do we need statement of changes in equity? Or what would be a problem if it's not there?
We know from not-for-profit mind, but my comment would be that it makes it clearer to just identify it in the statement of changes in equity.
And is it because it's maybe the effort to prepare such a statement is, let's say, not such huge for the value of that statement? Yeah.
For the value of preparing the statements, yeah.
Thank you very much. Anyone would like to make additional comment? I will see whether there is anything coming from our virtual attendees. And I just shared the.
I guess in terms of an alternative, whether or not the current AASB 1060 requirements where there's, if depending on certain movements, then you might prepare a statement of changes in equity. Would that be a sort of proposal that could be introduced for Tier 3 as opposed to just preparing a statement of changes in equity regardless of whatever movement is? Because it is a current Tier 2 requirements that they can not prepare and they can just prepare a statement of retain, what's it called?
Statement of profit and loss and return earnings.
Yes,
Yeah.
that's right.
And that's possible alternative. Okay, I see a couple of no's also from the virtual participants. So please feel free to I already shared results, but I will share now again. If you have any comments that you would like to make, especially for those that disagree, but in this case, we're actually equally interested in, well, we are always interested in any views, but this one is because it's falling somewhere in between. We are keen to hear on both sides of the arguments, especially on why. I didn't want to go further. How do I see? Yeah, I don't see any hands up other than one that is up permanently and nothing in the chat. Okay, thank you for that. Yeah, Belinda.
Yeah, so I would say I don't think it's a particularly onerous statement. I think it's a really important piece of the puzzle in understanding what is, general purpose or widely useful financial statements. And I think that answer probably ties into other questions in that, if you're going to have movements in fair value changes and things like that, that end up, affecting equity account balances, then statement of changes in equity will then show is essentially an important piece of the puzzle just to provide basic understanding, is my view.
Thank you very much, Belinda. Thank you. Very useful comments. Okay, if there are no other comments or questions, I will move on to the intangibles. And going back to the topic that we already started, when the staff of AASB actually looked at a very limited sample of the financial statements, we actually haven't seen much intangible assets being recognized on those balance sheets. The question was, is it because those smaller not-for-profits don't use intangibles, or they just don't recognize them, or they don't recognize them in a way that we can see them on the balance sheet? Maybe they are somewhere in other assets. So actually, board did not make any preliminary views whether and how to account explicitly for intangible assets. And we are now performing additional research on a now representative sample of those smaller charities, because the data are relatively easily available there to see whether they have some intangible assets on the balance sheet. So similarly, we would like to hear your views, and we will release polling question now is, what are the common types of the intangible assets that you see on those smaller not-for-profits balance sheets? And you can see there is a few options we gave you in this question. There is also category other. So if you have seen some other types of intangibles, please do let us know and put your hand up. And also there's obviously the option that there are no intangibles indeed. But so from our outreach so far, there are some intangibles that stakeholders usually see on those smaller not-for-profits balance sheets. So also in the room, this one is a bit harder, but if you have something to add that we see on the slides on a poll, please do let us know and feel free to put your hand up and we can chat. But as I can see from the virtual participants, software, licenses, patents, goodwill, trademarks are commonly, even copyright. So interestingly, no one clicked cryptos as yet, but from other sources, we have seen cryptos, and obviously you may be aware, ACNC actually released guidance how to deal with crypto, not necessarily from the accounting perspective, but more from the risk management and governance perspective recently. So that's a useful thing to look at. Okay. Any questions from or comments from the room on the types of the intangibles we see? Is there anyone who would not see intangibles on those smaller not-for-profits? And when I say see, I mean it's not common. Then depends what the definition of common. But essentially the question is it something that Tier 3 should be covering? And from what we have seen so far from outreach, again, personally, I would say probably yes, because it doesn't look like it's not uncommon. But if someone would have any further thoughts, to let us know. I will end the poll and share the results for our virtual participants to see as well as how they voted. Any questions or comments from the virtual attendees? Any hand up?
No.
Other than the one that it's permanently?
No, I think we can move on.
Okay.
Oh,
Yes,
no.
please.
Would goodwill include things like a membership or customer database?
Well, it depends. Obviously, goodwill arises on the business combination. So it really depends whether that purchase price was allocated to those types of the intangible assets you have mentioned, or whether they actually were separately identified. And then goodwill is really the amount of money acquirer paid that is not allocated to something that can be separately recognized, because I think some of the types could be separately recognized and potentially amortized over the life. And then goodwill is really the number that stands and represents value that acquirers saw in the target. All right, Maggie is telling me that we should keep on going. Thank you. There's something in chat. Thanks, David. So this is actually a very important topic. As we mentioned, the Tier 3 standard is actually going to be, well, aim is to have it as a standalone one standard. I'm not sure how long, hopefully not too long, but so we want to make sure that it's easy for Tier 3 accountants, auditors, stakeholders to use. But that means that standard will not cover everything. And we already touched on that on a couple of topics, including financial instruments. So here we state that the topics that might be omitted from the Tier 3 standards because they are not common and should not be so relevant for the small not-for-profit entities. Again, the question is similar to those financial instruments list. Do you agree with the list? Did we get it about right? And for example, business combination that we have listed as something that we thought that is not common, looks like it's actually relatively common these days, even at a smaller not-for-profit space, especially not necessarily from the acquisitions perspective, but fair bit of mergers or amalgamations are happening at that smaller not-for-profit space. So that's something that we need to take back to the board. Keen to hear again today from our virtual attendees and in the room, what do you think about that list? Would you strike something out? And is it, for example, business combinations, and that's something that Tier 3 should be dealing with, or is it something missing? Is it something quite visible that you think we should not deal with, and it's not on the list? On the business combinations, someone in the room, do you have a feel or do you have a view whether they are common or not common? Again, for the smaller not-for-profits.
Or if I can get a raise of hands, if you agree for the topics to be omitted.
Yeah, if the list makes sense. Okay, who agrees with the list as it's presented on the slide? Hands up, please.
If, for example,
If the small non-for-profit has, for example, share-based payments arrangement, what do they do? In my view, they should disclose.
Yep. So there is a hierarchy which essentially will tell them what to do if in case the topic is omitted. Now there will be some topics that will be explicitly omitted, and the standard would send them to the higher tier. Another option is that entities will be able to apply higher tier in their entirety. If, for example, they are small, but the whole of the balance sheet is complex financial instruments for whatever reason, they'll be actually say, you know what, tier 3 is not for us. And sometimes they might be told that tier 3 is not for them. And then there will be, and if it's not clear, there will be accounting policy similar to what we have in tier 1 and tier 2 that first start with a tier 2 topic if it's covering that particular topic. If not, then apply requirements of tier 3 in analogy and use, you know, obviously the conceptual framework, etc. So similar to what we have in AASB 108 in terms of the accounting hierarchy. So we'll end the poll and share the results from the virtual participants. And I think we have also comment from Craig. Thank you very much. Who thinks that the mergers and divestment should be included. So thank you very much, Craig, for that. We'll take that away to the board. All right, so I will stop sharing and minimize that and move on to the next slide. And that's topic that we just talked about in terms of the ability to opt up, but this is on accounting policy class by class transaction. So as I mentioned, on the left-hand side, the board has a preliminary view that entities will be able to step up in their entirety. The question is whether to allow them explicitly an accounting policy choice within tier 3, and if so, how? And those are the three options you see listed on the right-hand side of the screen. One would be essentially a free choice. And again, there is a balancing act between simplification and comparability of the financial statements. Then second option is when only the board within the tier 3 would allow that. So for example, there might be some similar to what we discussed, recognition of those non-financial donated non-financial assets, where there would be an option to recognize it at a fair value or cost, and potentially the fair value might be linked to the higher tier. Or option 3 is no accounting policy choices in terms of stepping up to the higher tier on a class of transaction basis, and everything would be contained for tier 3. And there is also the balancing act how the tier 3 would be long, essentially, because if we cannot refer to higher tier in no cases, we may need to cram more accounting requirements into tier 3. So Maggie very kindly released the poll, basically asking which option for the opt-up policy for a class transaction would you prefer. And obviously we have only three options, so I'm not sure whether there is 4th and 5th. If there is, please tell us. But it's an important topic because it may contribute to comparability. For example, if there is a free choice, one of the arguments is, well, we may end up with variety of accounting policy choices across very similar entities, and that's a valid point. It has the other side, of course, to it.
So I guess for the purpose of participants in the room, if I can get a hands raised for anyone that supports option 1, can you raise your hands? 1, 2, 3.
And don't worry, for this question, we have always almost like third of the room or the participants in each option. So it is something that we see diverse views.
Option 2, only when the board permits, and we would love to know which topics you think that the board should consider when the entities would be allowed to opt up. That's something that we are interested to know as well. So that's 1. And option 3, not permitting. Anyone?
Okay. That's useful. Thank you. And I just released the poll also to the virtual participants, and feel free to let us know any comments or questions or views supporting any of the options if you would like to share them now. Let me see. I don't see any hands up or anything in the chat. Okay, I realize that we are 2 minutes over the time. So very quickly, obviously, we had a limited time. We couldn't, the discussion paper is 120 pages long. So we obviously were not able to cover all the topics. Here you have some of those that we are proposing further simplification in terms of the either language or recognition measurement. That's the left-hand side of the screen in dark blue. Right blue, so topics in the dark blue on the right-hand side are those that didn't attract too much significant comments from the stakeholders during our targeted outreach. So board's preliminary review was to apply New Zealand Tier 3 requirements, simplified requirements to those, for example, provisions, commitments, etc. There is a more operational considerations that are listed at the bottom of the slide in light blue. And one of that again, we haven't discussed today in depth, but one of them I would point your direction to is the possibility of removal of ability of not-for-profits to prepare special purpose financial statements. Again, because we have seen that there is a bit of diversity in practice, the view is that Tier 1, Tier 2, and Tier 3 will contribute better to the consistent financial reporting beyond the concept of special purpose financial statements requirements. Did you want to do something?
Oh, I was going to say, if you want to launch that, or maybe not.
Yeah, I think we'll just move over. Again, as Maggie mentioned, there is a number of ways how you can provide further feedback. There's online survey which has all the questions in discussion paper. I think it's more than 40. So definitely that covers all of it. And just send us an email, or you can write as a comment letter as we do. Now, if you want to, you don't have it? Okay. We will have our contact details. We don't have a polling question, but if you have anything to share with us, please do give us a call or send us an email, and we are always happy to chat. Few resources for you. I'm not going into detail. I'm not sure whether the slides are being shared, but I think yeah, and we can send those links in the email to the participants after the session as well. This is just how you can interact with us. I'm not going into details because of the time. Thank you very much. I realize that it's your lunch break, so thanks for having us and listening to us and giving us feedback. Absolutely useful, and we will discuss with the board after the comment period closes, which is 31st March this year.
So I'll hand back to Ishi for closing.
Thank you very much.
Thank you.
Thank you very much, Maggie and Freddie. They flew in this morning, so a big thank you to them for being here today. Our next session will be on the 18th of April, and we're going to have an ACNC speaker. So it's going to be Mel from the ACNC, and he's going to talk about related party transactions. So we'll see you all in about 2-ish months' time. Thank you very much for your time today.
Thank you.